Sometimes sole traders will join with others to form partnerships as a way of spreading the risks and work involved. This can happen if their business grows. A partnership is when between 2 and 20 people get together as owners of a business. The advantage over sole trading is that partners can usually raise more capital between them to start off the business. As with a sole trader, the law makes no distinction between the debts of a partnership and those of the individuals who are partners. So all the partners are liable for any mistakes that are made. They have unlimited liability. In a firm of accountants who are partners, for instance, if one accountant was being sued for damages because they had been negligent, then every partner in the firm would stand to lose. And not just their stake in the company, their personal wealth would be at risk as well. Lots of people want to invest in businesses, but investing in sole traders or partnerships who have unlimited liability is a big risk, especially if you've only invested a small amount. You could lose everything. It is essentially to avoid this risk that limited liability companies are formed. The difference here is that if you invest in a limited company that goes bust, you would be only liable to lose up to the amount that you'd initially invested. An investment of this kind is usually in the form of shares, which the company sells in order to raise money to finance its operations. A share is a unit of investment representing a stake in the ownership of a company. Think of it as a small piece of the company. If the value of the company increases, your shares grow in value too. The number of shares you own determines what share of the company's profits you eventually receive. Shareholders are people who buy shares either through the stock market, where anyone can buy them, or privately when a company approaches specific people. When shares are only available to be bought privately in this way, the company is a private, limited company. Watch these two clips about two private limited companies, Siberia Cafe and Dr. Martens, and answer this question for each. What are the benefits of being a private, limited company?
The internet is a network of computers, and these computers are from various places of the world. It means that people can actually talk to each other via these computers. We make our money by selling internet access to the people. Siberia Cafe is a limited company, which means that as a managing director, my personal liability is limited. To explain that further, means that if we go into liquidation, I'm only liable to whatever amount of shares I have in the company, so they can't take away my house or any other properties that personally belongs to me.
Not a lot of people know the Griggs Group, but a lot of people know our product, which is Dr. Martens footwear. Our Griggs is a private limited company. It exists to make a profit for its shareholders, and we do that through manufacturing footwear. We actually think it's beneficial for us to be a private limited company because as a family business also, we're really responsible to for our own destiny. We are the shareholders, and also we make a profit therefore for ourselves. We don't have to answer to the city or any other institutions.
If you need to, rewind the tape and watch it again. The benefit for the managing director of Siberia Cafe was that her personal possessions are protected should she get into debt. So, no one can take away her house. Briggs Company, making Dr. Martens was a family business with family members holding shares and sitting on the board. This means that the business is self-contained, with a small number of owners to make decisions and share profits. So, a private limited company is owned by shareholders who have limited liability. You can identify a private limited company by the fact that it will have limited or the letters LTD written after its name. Unlike a sole trader or partnership, a limited company has a legal existence separate from its owners. And of course, the main financial objective of this business is to make a profit for the shareholders. Private limited companies have to obey certain rules about selling their shares. They can't trade shares publicly on the stock market. They can only sell them privately through individual transactions, and then only with the agreement of the other shareholders. Shares must also always be offered to existing shareholders first. This means that it's less easy to raise large amounts of capital. This summarizes the flow of control in a private limited company. That structure is also true for the second type of limited company, the public limited company. This is where it gets tricky, because a public limited company is significantly different from the private kind. These companies can be identified by the PLC written after their names. A PLC's shareholders still have limited liability, but they are what's known as public rather than private shareholders. This means that the shares are sold publicly on the stock market rather than by private arrangement. Finally, PLCs usually have a much larger number of shareholders than a private company. This means that some different rules apply. Unlike private limited companies, public limited companies usually have thousands of shareholders, each owning a part of the company relative to the number of shares they hold. Watch this next clip about British Petroleum, a PLC. Then answer these questions. What are the business's objectives? What happens to the profit? What do you think the benefits and drawbacks of this kind of company are?
BP is a public limited company. I guess all public limited companies have this sort of simple raison d'etre of making money for their shareholders, but that doesn't seem to me to really capture what a company's about. It's true that that's what we want to do, but of course we have to do that by doing something. And our purpose is to supply fuels and chemicals to people and do it in the best possible way. Internationally, BP is the third largest oil company. The cash BP makes gets really distributed in three ways. The majority gets ploughed back in the business to grow it, to make it more effective and more efficient. Then we have to do two other things. We have to pay the interest on the money we borrow from banks, and we have to make sure that our shareholders are properly rewarded. That's by dividend, by the money we pay them every quarter for their shares, and also, of course, by the way in which their share price grows in value.
Well, BP's aims, like those of any limited company, are to make a profit for the shareholders, and they do this by supplying and selling fuels and chemicals. Its profits get distributed in three ways. Most get invested back into the company to expand it, some goes to pay the interest on loans, and the rest goes to the shareholders in the form of dividends. A private company can become a PLC by selling, or floating, its shares on the stock market. One of the main benefits of companies becoming public limited companies is that large numbers of people buying shares brings new money into the business. One possible disadvantage, from the point of view of the original owners, is that a PLC must have important decisions about the company voted on by its public shareholders through an annual general meeting, so the directors have less control. So, to see if you've taken all that in, have a go at this question. Describe the features of a private limited company and a public limited company. Would you recommend to the Griggs Company that they remain a private limited company or become a public limited company? Well, a private limited company, as we've seen, has limited liability and fewer shareholders who are privately chosen. A private limited company is therefore easier to control, and the profit is shared between a smaller number of people than in a public limited company. A public limited company also has limited liability, but its shares are sold to the public, and it usually has a much larger number of shareholders. A public limited company can raise more capital, but its shareholders must be included in decision-making through an annual general meeting. And of course, there are more people who have to share the profits. You might have decided to persuade the Griggs Company to become a public limited company because they would be able to generate more capital, expand their business, enter new markets, or buy new technology. You might have easily convinced them to stay as a private limited company though, because although they might expand at a slower rate, they could continue to keep control of their business and profits within the family. Well done if you got most of those.
The worst exam situation I found myself in was in a technical drawing exam. I had no confidence in myself whatsoever for this exam, and I sat outside the exam hall thinking I can't go in, and it literally took one of the invigilators to come out and say, "Graham, do you know you've got an exam now?" So I went in completely lacking confidence, did my best, was as relaxed as I could possibly have been because I didn't think I could achieve anything. And to my surprise, when I opened my envelope after the exams, I passed. So, whatever the circumstances are, don't let your nerves overcome you. You may feel you don't have a chance of passing an exam, but believe me, I managed to do it once, so I'm sure you can too.